I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers Podcast Show, and today is Thursday, August 18th.
And this is your interest rate update.
If you're new to the channel, be sure to subscribe, comment, and like. We do this Monday through Friday. And remember, this is for informational purposes only. This is not financial advice.
That's right. We're not your financial planners. We are your mortgage brokers.
Okay, so update today. 30-year fixed conventional loan, 4.99. The 15-year fixed, 4.375.
The 30-year FHA, 4.5. The 30-year VA, 4.5. We could have taken a picture from yesterday. Exact same across the board, all these rates.
I think there was one of these that was a little bit different. I think maybe it was a 30. Yeah, it was one of these had ticked up a little bit. But yeah, all same rates. These rates also come with no extra points, no extra fees to get the 4.99, for example, on a conventional loan. This is the scenario we price it on for conventional. Here's the FHA scenario, and here's the VA scenario.
And remember, these are real scenarios. They're very likely. They're not some 1% chance that you're going to fall into this bucket like some of the coupons and discounts that you see out there. All the loans do have standard closing costs, but there's nothing extra.
Yeah, I think about 80% of our customers have over 740.
Yeah.
We should show us. There's some research that was done. Actually, most consumers actually have good credit report scores. Maybe we go show that.
Yeah.
Credit.
Mm-hmm.
I want to show you the whole idea of what is it as far as those points go. We're showing 4.99. That's what we're showing. That's what we can get in the market for that scenario. Freddie Mac is the agency. It's an agency that buys the notes. Same with Fannie Mae. Now, all you have to think of is this: they're the agents. They're the bank behind the bank. Or they're the agency behind the bank.
Yeah, and they're basically buying these notes at a discount so that interest rates are low enough for the American people so that homes can continue to sell.
So Freddie Mac buys and holds more notes than all the banks. I mean, the banks don't really hold notes. And based on their survey, which comes out once a week, interest rates that they're seeing are 5.13 for a 30-year fix. Lenders are charging 0.8 of a point.
Almost 1%.
Almost 1 point. We would call that like 1 point, but there's 0.8. And 0.8 points equals $3,200 in our scenario here. So if you had a $400,000 loan,
yeah,
so 0.8 in points would be $3,200 of extra fees.
So not only is the average, bank or the bank, the average of all the banks, quoting higher rates than we are, but they're also having these points.
Yes.
So it's kind of a double whammy.
Yep. So you would probably get an interest rate quote if you were out there looking, especially on purchases. If you're out there looking at a home, it's a home purchase, you're going to get higher rate quotes than most, and you're going to probably be at 5.13 to 5.5, and you're going to have points.
Yeah. And if you're already far enough along in the process, you're like a week away from closing, don't worry. Close on that home you just purchased. Hopefully you've got some instant equity, and then we can simply refi you after you guys close.
And okay, next, we went over this yesterday. It was amazing. One day, this is the Fed rate probability that comes from the Chicago Mercantile Exchange. I'm not sure if anyone really likes looking at this chart. I kind of like it. We've been talking about it, but I'm hoping that the audience likes it. Because there's a lot here, but just think about it this way. The next meeting is next month. There's a 65% chance that the Fed will raise the rate 0.5%. Mm-hmm. Yesterday, that was at 50%.
Both 50. We talked about that. We were asking how quickly will these change? They can change daily, if not, a couple times a day.
Yeah. So overnight, traders have believed that we're going to only have a 50 or 0.5% rise, which means they really do believe the Fed's not going to be as aggressive as they think.
Mm-hmm. Why? Because they do think the economy is going to start to slow, but they want it to slow. They want that inflation number. So I think if I'm reading this correct, some of what the Feds are trying to do is working.
Yeah. And November 2nd, I did look up the midterm elections are November 8th. So this is a week before, basically. There's 85% chances based off today. 85% chance the Fed will raise the I should put raise there, but raise the Fed rate another 1/4 to 0.5%.
Mm-hmm. Okay.
And then December, about 80% chance, another 1/4 to 0.5%.
Yeah. So hopefully we start to see it tapering.
Yeah.
You know, as you go all the way out to February, I don't think we've seen a zero before in quite a while.
So it's very possible it'll be a zero. Maybe we'll be done. We really do hope. A lot of people are saying that we'll be done once we hit 3.5%. Basically, there are analysts who say that we can't. If the Fed rate goes above 3.5%, nobody can pay the debt. Corporations can't pay the debt. The banks can't pay the debt. Our country can't pay the debt. So again, and Tom mentioned the good analogy is, you tell your child when you're trying to discipline them, you give them a warning. Don't do it, or I'm gonna
take the keys from the car.
Yeah, and then you count to 4, and then you say it again. Usually you count to 3. Right?
Yeah,
but you never. Right now, the Fed is talking. They're basically warning everybody. Hey, if you do this, if the economy overheats, we're going to do this. But I think what they're doing is they're trying to scare the economy so that the economy can just correct its actions.
Yeah,
the businesses can
contract. Using the analogy that you just said, taking the car from the teenager would be pushing the Fed funds rate to 4%. And what Ed was saying was that there's a report out there saying that we really can't handle anything above 3.5.
And the Fed knows that,
and the Fed knows it, and kind of like the parent, it's you kind of know you can't take the car from the kid. You're just really hoping that they don't step over that line. So interesting. You have a little bit of psychology going on here, which I guess kind of makes sense.
Yeah, so they know that if they speak a certain way, the market's going to react, and that's what they're hoping for.
Yeah, and they're getting it. Things are slowing.
The parent will talk tough, and they're hoping that the behavior will change.
Yeah, because Yeah, that's right. Because just like the parent, the Feds do not want to have to go through the pain.
Yeah,
that it would give the economy in order to do what they really needed to do. They just want it to magically happen, like your kids. You just want them to magically listen.
Yes. Okay, that's today's update. We'll be back tomorrow, everybody.
Thank
you.
Be sure
to subscribe, comment, and like.
All right, thank you, folks.
Thank you, everyone, for watching our show today. If you have questions, be sure to email us at rates@azmortgagebrothers.com, and be sure to take a look at all of our other videos on our channel.